Welcome to Startup Success, the podcast for startup founders and investors. Here you'll find stories of success from others in the trenches as they work to scale some of the fastest growing startups in the world. Stories that will help you in your own journey. Startup Success starts now.
Welcome to Startup Success. We're back with one of our most popular guests, Steve Lord, the Chief Operating Officer at Burkland. Thank you so much for being here today. Steve also runs our knowledge share practice, which keeps all of our CFOs, accountants, everyone working with clients up to date on all the latest and greatest in the startup ecosystem. Steve, welcome back. Thank you for being here.
Awesome. Thanks for having me.
Yeah, we're going to delve into the current state of things and a recap after Q3. I mean, where are we with the economy? Q3 is ending.
Yep.
Tell us.
And anybody who's paying any degree of attention knows that the market is fixated on the jobs numbers and the inflation numbers, right? Those are the two things that are alternatively driving the political discourse and the pressure on the Fed and internally within the Fed itself, right? We did get a cut, which was awesome. We've talked on this program several times about when that was going to happen, so I was really glad to see it happen. It was, I feel, a little bit more of a kind of a sop to the pressure. I don't know if they actually had data that needed to push that, because remember what the mandates are, right? Full employment and low inflation. And there's this shadow third mandate that they went back and dug out of I think the Federal Reserve Act in the 30s that speaks to low long-term interest rates. Right now, we haven't really talked about that ever. From Fed watchers for 30 years, I've been doing this a long time. There's never really been a lot of discussion around how the Federal Reserve could manipulate long-term rates. But there is a thing there. If they were able to start doing that, that would trickle its way through the economy. One thing I want to call out, though, is yes, we got a rate cut. Yes, we're probably going to get at least 2 more, maybe 3 into January of another 75 basis points, maybe 100. But I think for us to really go beyond that, we're going to have to see, it's kind of like, don't be careful what you wish for, because you'll have to see a dramatic deterioration in the underlying economy. So everybody's like, lower interest rates, yay. Well, yeah, but hold on, right? Because they're only really doing that if they are worried about where things are going to go. 2 other quick points. The 2 big levers that we're all talking about right now, the interest rates and the tariffs, both of those take 12 to 18 months to percolate all the way through an economy. Okay. So the interest rates that we're lowering now are going to be visible a year from now. The tariffs that we put in April and May are going to really start showing up in the beginning of the spring. There is a gestation period to these things that virtually everybody pounding away on their keyboards online don't really talk about, right? Don't look at inflation now to see whether tariffs are impacting it. It's going to be inflation in March that shows it. And that's what the Fed is worried about, right? They're not going to cut interest rates like crazy because they know that is coming. So it's a complicated time. The economy, I'll also just call out, is in good U.S. economy fashion, is typically stronger than the rhetoric. It once in a while you'll see it the other way, but it is usually such that we almost talk ourselves into recession. Underlying economy is still doing pretty well. We hear a lot about these folks that can't find jobs and all that sort of stuff. And we're hearing a lot about how the Bureau of Labor Statistics doesn't know where it's getting its data from. And that's fine, but it's not different, right? The big thing with the Fed is it any different than 10 years ago? The answer is no. So underlying economy is still actually pretty healthy. Go forward economy, interest rates, inflation, and to be honest, the political pressures around those 2 things are things to watch.
Okay, because that was my next question. They did that small rate cut, and then everyone starts talking about recession jitters like immediately.
Right.
But you're saying it's still underlying healthy. It's more like long term.
Yeah, because remember what drives the economy going forward are businesses acting on anticipated needs, right? So things like the stock market are great forward indicators. A lot of people are talking about how the economy's going to go down the tubes, but then you're looking at the equity market is continuing to do really very well. I think we're on was it I can't remember the exact statistic, but it's the longest S&P streak in at least a year or so without a down day of more than a point, right? 1%. So that's telling you something. There is a split there. We can worry about the economy all we want, but don't forget one of the great Wall Street sayings is bull markets climb a wall of worry. So everybody's wringing their hands, going, "Oh my God, it's all terrible. It's all going to fall apart. We're all going to lose our money. The world's going to crash," and the equity market continues to go up. That's actually very common. Um, just bear in mind that the way economies realize what they are going to do is businesses acting on their planning. So right now, a lot of businesses are still in that place we were worried about last time we spoke, where they don't really know what's going to happen, so they're just waiting. And we're seeing that start to show up in some of the surveys.
For sure. It feels like with the rate cut, just talking to people in the industry, people immediately became more cautious.
Yep. 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 And that's a natural reaction because Wall Street does this too. Well, what does the Fed know that we don't know, right? But in this case, I feel like a lot of the folks that really watch this know what that rate cut was really about. It was really about getting the White House off their backs.
Right, the political
Right.
pressure.
Now, to be honest, that is a dynamic that I have never seen. So that's new. That is a thing that we have to handicap as some sort of exogenous influence that hasn't really been there, at least not overtly. There's always been accusations that Feds were political here or there, but broadly they have been resolutely independent. And I think that independence is still intact, but this is certainly kind of new territory for the Fed. Last thing I'll throw out there related to all of this stuff is watch the dollar. The dollar will continue to be weak, right? If we're on an easing cycle, you're seeing these other economies, changing their interest rates in response to what we're doing. The dollar will probably continue to run into exchange rate issues. However, that has a stimulative effect on the economy because it makes our exports cheaper.
Oh, right.
So don't forget a weak dollar. Don't read into the online, sky is falling stuff. It's actually in the United States' economy interest that the dollar drops a little bit.
That's true. That's a good point. Okay, so that's helpful to set the stage for the economy. Let's go into the world of startups. What
Right.
is going on with VC investing?
The Probably the easiest way to sum it up from 50,000 feet is it is really two markets, right? We've talked a lot about how the venture ecosystem is sort of stalled, waiting for shoes to drop, and I think that's still broadly true, except AI. If you are AI, you look at the charts and they're all up and to the right. The number of deals, the value of the deals, the premiums in terms of valuation on those deals. We've had mega fundraisings from OpenAI and some of these other companies that have really skewed a lot of the numbers. If you take those out of the chart, it's still pretty flat. It's just really not getting much traction. So I think the message for our founders is, I mean, it's kind of twofold. If you can put AI into your business, figure out a way to do it, because you'll be able to raise money easier for it, right? And if
So
you don't,
everybody add a slide about AI to their pitch deck.
right, get it in there. I mean, it's we had some conversations internally about this. AI is going to end up being even more this way than fintech was, right? When fintech first came out, everybody thought it was just going to be lenders and banks. But then eventually, I think it was Andreessen Horowitz that coined that every business is a fintech now, right? Every business is going to be AI. That's going to happen one way or the other. Either you're selling it or you're using it, right? One way or the other.
Right.
So I think it's not a stretch to start trying to figure out ways to incorporate it. If you aren't doing that, we do see companies getting funded, but it's going to take longer. It's going to be harder. Your valuations are going to be more difficult. If you are looking for additional fundraising, it's still very likely. I think it was more than 20% of all rounds right now are either flat or down. So you're going to need to adjust your expectations around what getting new capital into your business will look like.
Yeah, if you want to fundraise or you have to fundraise, you adjust your expectations. But any other advice there?
What we've seen is largely the folks you already have on your cap table are probably your best bet. They have an investment to protect. They know you. They know the business, right? Have really candid and honest conversations about their willingness to backstop another raise. It's always easier to raise money if your existing investors are re-upping for a new round. If you don't have that, you already have a strike against you, because the first question that comes to a new investor's mind is, well, then why aren't these guys if you're so great, how come these guys aren't putting up more money, right? So I would start there. And accept the fact that you might have the most amazing idea under the sun, but the environment is one that's going to look at you skeptically. So you have to be even better than normal, even more like sure of your case. You have to illustrate the KPIs, data driven, all of those things to convince people to write a check.
To go back to your first point, I thought that was a really great tip for founders listening to start with your current cap table. It makes me think that even if you're far from fundraising your next round, you should be then communicating pretty actively with your investors and like thinking of them as that future pipeline, right?
You bet. You bet. I mean, you should be doing it anyway, but in this
Right.
context, absolutely. And one of the things we've also seen with some of our founders is, you're going to have to raise money in a year, right? You built the product's out there, it's okay, maybe it's growing a little bit, but you haven't found the secret yet. You're not blowing the doors off yet. Talk to them early about pivoting. I mean, if you feel like the business needs to go in a different direction to hit the kind of numbers that will enable that fundraising to happen and everybody to have the outcome you want, don't be afraid to do that. They have the same interest in that outcome that you do. So founders sometimes, it's like with the equity market, you sort of fall in love with the stocks you buy. Sometimes we've seen founders stick with the core idea a little longer maybe than they should have, and then they are on their back foot, and now they're almost out of money. Now they have to raise. Now the business doesn't really have good metrics to show for it. Now you're really in a tough place.
I'm really glad you called that out because just on this show, we've spoken to so many founders who said they made a pivot early. And even though it
Right.
was so hard and
Yeah.
scary, it really paid off. So if that's what
Yeah.
your gut, you're feeling it. And I love your idea about talking to some of your, early investors
Yeah.
there about it.
They know, especially if you have the traditional sort of venture backing that many of our clients do. The investors on your cap table know more about raising money probably than you or your management team. If you're a founder, listen to them. They will start telling you what's going to be doable in a year or 8 months. We had one client recently that finally closed a seed round. It took them 9 months, and they have some of the best metrics I have ever seen. And it
Wow.
still took them 9 months. So, folks, you got to be, if you're gonna be in it, you got to be out there thinking now. I don't really even care how much money you have in the bank. You need to be thinking about talking to your investors about what's next.
9 months.
Yeah,
That's
9 months. And they have a great story. So it's one of our CFOs. They're working with one of the best folks on our team. Their deck is tight. Their product is working. Their sales velocity is high. Their team is excellent. I mean, excellent team, right? All the right things. 9 months.
so you have to get out there probably sooner than you think, start the process sooner than you.
At least the conversation with your existing investors, right?
Okay.
Yeah.
Okay. And as far as your deck, the second point you made that I thought was really good was you really focus on KPIs, metrics,
Yeah.
give them a lot of like hard data on why
Right.
it's a good decision.
Right.
Okay.
So dry powder is really still at a record, right? By vintage, it's even wider than it used to be. So older funds are carrying more capital. The
Okay.
corporate environment, so think of the Metas and the Googles and the Intels, the folks that come alongside and invest in these companies too, they're getting more active, and they're able to stay with a client all the way, or with a portfolio company all the way through an IPO and beyond, right? So, but the venture dry powder, the unlocking of that sort of capacity, really, if you If you expect them to buy into your vision, it's not the right marketplace for that. That was 2018, that was 2021, where if you were an AR company, you could raise money on a pitch deck, right?
Right.
Now it's you gotta have the vision, sure. You have to have the team, you have to have the economics figured out, but you have to have a very clear, and this is such an important point, clearly and succinctly delivered pathway to getting the company where you want it to be, right? Because right now you're going out to the market with a 44-page deck. It's not going to work. It's really not going to work unless it's being carried to a new VC by one of your existing investors. Maybe then, but it's got to be tight, really close, a lot of data, a lot of knowledge. Sure, have the concept there, but back it up with information. And it sounds simple. Like I'm sure everybody listening to this is like, well, yeah, of course, right? You'd all be surprised what founders put in their deck, because I get it. I mean, we love the ideas that we come up with, right? We believe in them and we believe in ourselves and our team. And so a lot of decks have a higher proportion of kind of the pie in the sky, right? Like I remember a crypto deck I got years ago where the first 3 pages of the deck were about how, this is the libertarian revolution and we're going to, democratize money, and this company was going to put MasterCard out of business. And they lost everybody by page 4.
Page
It
four.
just wasn't, yeah.
Yeah.
So anyway,
Okay. That's really helpful. I think you laid out some really good advice there. Anything else as we wrap up? I'll talk to you again next quarter, but
yeah, I've said this for several of these episodes and I'm just going to say it again. Venture, startup financing, growth company financing, growth PE, that little like corner of the broader market is cyclical. Okay. It doesn't feel it right now. It feels very kind of like a U, right? But it is a cyclical industry. It follows rates. If we do get 3 or 4 rate cuts coming into the spring of next year and these other economic indicators, we're kind of balancing that line successfully, this ecosystem will turn. I staking my credibility on it. It will. The
okay.
venture model is not broken. It's just got macro headwinds on it right now, and that's, you can go back through time and see it on the charts how it
That feels good to hear because it
has
does
something, right?
we're at the bottom of the U. So it's
Yeah.
good to hear that the venture market, people need to remember, follow macro trends. I think
It
that's
is a cyclical industry, right? It's like
cyclical.
aluminum and steel and copper and all these other things. Plus, many of the listeners probably weren't active in the market at the time, but if you go back to post financial crisis, 2012, 2013, 2014, we had zero interest rates for years
Yeah,
and
money.
we were at the top of a cycle,
Yeah,
right?
yeah,
And nobody's remembering that part.
yeah.
This is the answer to that, of
Great.
course, right? There's a
Okay.
hangover after every party.
All right. I like it. That's the optimism that we can take. So I appreciate that. That's helpful.
Awesome.
Thank
Looking
you.
forward to coming back.
Yeah,
You're
always
welcome
great to see you. We'll talk to you again in
as
a few
well.
months. All right. Thank
Thanks.
you.
Bye bye.